The U.S. is at its highest level of inflation in over 4 decades as prices on everyday consumer goods surged in March.
That's right. The Labor Department says gasoline, housing, and food prices are the biggest contributors to last month's spike. According to the latest Consumer Price Index, inflation rose 1.2% in March. That's an 8.5% increase from the same time last year. It is the fastest annual rate of inflation since December of 1981. The report reveals energy prices are a major contributor to the latest spike. Gasoline prices have climbed 48% in the past 12 months, while the cost of fuel oil has skyrocketed by more than 70%. According to the latest CBS News poll, 65% of Americans think the president could do more to combat the elevated cost of gas. The national average is down from its peak in March to roughly $4 per gallon.
The U.S. is at its highest level of inflation in over 4 decades as prices on everyday consumer goods surged.
All right, done. All right, done. All right, done.
All right. Today is Tuesday, April 12th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's dive right into it. In focus. Inflation is peaking, or is it? Let's start by this because a lot of people are attributing the reversal of the market today and closing in the red due to the events that took place in New York City today. And I say no, this is not the reason behind the reversal because we know that the stock market loves destruction, wars, shootings, nuclear weapons, civil wars. The market goes higher when we have these kind of disasters. So this was not the reason behind the market reversal today. It was another reason, and spoiler alert, it is inflation. But let's start by this. The fools in the media in the morning were jerking off right off the gate because the futures blasted higher after the CPI reading. And here's an example from Bob Pisani of CNBC who said, why stocks are gaining and rates falling on that hot inflation report. And if you want to know, you got to pay CNBC Pro, the subscription, $30 a month, baby, and we'll let you know why the stock market went higher. And rest assured, you don't have to pay CNBC anything because they don't even know what's going on with the stock market right now. But the headlines in the morning were, inflation is peaking, the stock market is shrugging off the hot CPI reading. The market is shaking it off. And by the end of the day, here it is, the S&P 500 NASDAQ fall for a third day, reversing earlier gains after report shows highest inflation since 1981. So I guess in the morning, we were expecting peak inflation and the CPI was good news. And then by the end of the day, it became bad news and we realized it's not going to be peak inflation. Who are you kidding here? All what you have to know is the charts told you yesterday they're not ready to move higher. They want to go down and retest the support below before they move higher. So whatever trap the predators built up for us in the morning, I did not fall for it. And you did not either. You know why? Because you watched this program and you knew ahead of time that the charts were saying they're not ready to move higher. So whatever gap they gave us in the morning, we're not going to fall for it. We got to go down, retest the support below, and then take it from there. But anyhow, you know that the BlackRock administration yesterday sent out Brian Deese to massage our expectations. Yeah, inflation is going to be hot, but rest assured, it was expected. Why would they do that? Because they want to prevent the stock market from crashing. And what was the inflation reading? Here it is. U.S. inflation rate leaps to 8.5%. CPI shows as higher gas prices slam consumers. Meanwhile, inflation in certain cities in the U.S. has already surpassed 10%. We're talking about Tampa, Florida, Riverside, California, also above 10%. And then we have Denver, Colorado at around 9%, Dallas, Texas at around 9%, LA, 8.5%, Minneapolis, 8.2%, San Diego, 7.9%. Are you kidding me? Inflation in San Diego is at least 15%, if not more. But this is, after all, the kitchen, the Bureau of Labor Statistics. And the cooks gave us exactly 8.5%. Are we children to believe that inflation is really at 8.5%? Or did the cooks pick the sweet spot? The consensus says 8.5%. We'll give you 8.5%. Not too hot, not too cold. And here comes the peak inflation crowd once again. You gotta buy stocks. This is peak inflation. Inflation is gonna go down from this point on. They were all over TV today. Peak inflation, peak inflation, peak inflation. Even Jeffrey Gundlach came out today and said it is peak inflation. By the way, when was the last time we heard peak inflation? This garbage talk. Oh yeah, back in December of last year, when your boy Joey B came out and said, this is the peak. Come on, man. And we now know it is not the peak. But rest assured, Joey B says, I got it right. Inflation was supposed to peak, and then came Putin. Blame it on Putin, not on me. And of course, nobody's buying this garbage at all. Inflation is crushing Joe Biden and the Democrats. And this is coming from CNN. And this is becoming a major problem. We have people posting those stickers with the Joe Biden thing, I did that, on the gas station pumps. Well, somebody got arrested yesterday in Pennsylvania for posting those stickers. But I bet if you posted those stickers with Putin saying I did that, it would have been a different story, right? You got to go with the narrative. But here's the problem with this inflation, folks. It is crushing the standard of living in this country. When we look at the average weekly earnings on an inflation-adjusted pace, well, your wages are declining by the most in data going back to 2006. So when they say this is a booming economy, what are you talking about? Better yet, what are you smoking? We have the lowest standard of living. Wages are declining because inflation is eating those wages like Pac-Man. You get excited for getting a 5% raise. Well, inflation went higher by 8.5%. And we know when the cooks say 8.5%, it's actually 20%. So net, the majority of Americans, if not all Americans, are down. What is the point of working right now if you're going to be down either way? You cannot afford rent, you cannot afford groceries, you cannot afford gas, you cannot afford utility bills. What is the point of working? And inflation is becoming a global phenomenon, by the way. Look at that. USA, number one, 8.5%. Take that, China. Take that, Japan. Take that, Germany, although Germany is kind of catching up with us. Watch out, Germans. You think you're going to beat us in this one? You want to feel the might of the United States? But we're beating Britain, we're beating France, we're beating Canada, we're beating South Korea. Number one, baby. Number one. And here's what's going on with the CPI inflation. 8.5%. This is the all item, which is bullshit, by the way. I'm going to prove it to you in a second. But fuel oil up 70% year over year. Gasoline 48%. Used cars and trucks 35%. Airline fares 23.5%. Meats, poultry, fish, eggs almost 14%. Electricity 11%. Cereal, bakery products almost 9.5%. Fruits, vegetables 8.5%, dairy, 7%. And what is dragging the CPI down, by the way? How about rent? Yep, because according to the cooks who produce the CPI, rent inflation went higher by 4.4% year over year. Now, are we children to believe any of this garbage? Of course not. Even children, by the way. No, this is a lie. And if you're a child watching this program, please let us know in the comments so we can inform your parents. Anyways, as you can see, all in all, everything is moving higher, with exception of used cars and trucks. It appears that it is peaking. Let's pop the champagne. Inflation is over. Right? Wrong. Now, of course, the pumpers are excited about the drop in used car prices month over month, and they say, here's the proof that inflation is peaking. Hold your horses. Let's talk about groceries first. You know, because that's more important to the American public than used cars. Last time I checked, I did not eat Toyota RAV4 for breakfast, so let's talk about what's important here. Grocery prices climbed 1.5% last month, pushing up annual grocery store costs by 10%. That was the largest annual gain for the category since 1981. The price for rice rose 3.2% on the month, while costs for meat, poultry, fish, and eggs also increased. A bird flu outbreak in the United States could further drive up poultry prices in the coming month. Lovely. Reduced grain and global fertilizer supplies tied to Russia's invasion of Ukraine could trigger ongoing food inflation, said Richard Moody, economist at Regions Financial Group, in a research note. So the good news for the Biden-Powell regime for now is they have a new excuse besides the Putin inflation excuse. Now they have the bird flu. Oh, inflation is going higher due to the bird flu. It's not due to the cocaine operation. It's not due to the insane spending. It's not due to the stupid sanctions. It's not due to the insane level of demand in the economy overwhelming the supply chain due to all of that loose money being spent around. It's the flu. Okay, here's the bit about used cars. Used vehicle prices fell last month, even as travel-related prices, including airfares and hotel rates, surged amid lower case counts. The decline in used car prices provides some relief for consumers looking to make a big-ticket purchase. Yeah, good luck finding a car. Strong demand and a shortage of computer chips, which limited supplies of new vehicles, oh, and by the way, the EV lunacy, drove up used car prices sharply earlier in the thing. Still, from a year earlier, used cars and trucks prices were up 35.3% in March. New vehicle prices rose by 0.2% last month and were up 12.5% from a year earlier. And here's the big bomb that we got from CarMax today. I used to be a shareholder, and my thesis was they have a huge inventory and used car prices are moving higher. So the company is set to make a killing from selling those used cars at marked up prices. And it's the same thing for Carvana and the rest of them. But at some point, after you sell all of that inventory, you have to buy new inventory. Well, guess what? To buy new inventory, you have to pay those insane prices. And your advantage, poof, gone. The whole thesis for buying the stock is gone because your margins are going to be squeezed now. And this is exactly what's going on with CarMax. Now, they say that this is a sign for demand destruction in the economy. I disagree, but here it is. CarMax reported a 6.5% drop in the number of used cars it sold last quarter in stores that have been open at least 13 months. The average price of a car rose 40%, or $8,300. Is there some truth to the demand destruction theory? Yes, and we talked about that in details in this channel. When you have the consumer chasing gas prices, utility prices, rents, groceries, they're not going to spend on non-essentials, and buying a car right now is non-essential. So of course we're going to see demand destruction. Oh, we're just getting started, baby. But here's another problem. You have a company that cannot find inventory. They can find shitty cars that nobody wants to buy, but they cannot find the popular models, the SUVs. They're too expensive. You cannot buy them at these prices and flip them for a profit. That is just the truth. So business is stalling and stagnating in this company and many others. But here's the reality for all of those who say it is peak inflation, evident by the drop in used car prices month over month. Here's Jim Bianco, and Jim Bianco still has the laser beam thingy going on. But he noted something important, and he said, note that Car Guru's near real-time index bottomed on March 21 and has recovered most of the decline since the January peak. A core inflation rebound in April? If this indicator is reliable, then we will see used car prices rebounding higher next month. Why? Because you have no other choice. This is the inventory. No new cars are available, and this is going to be the situation for a long time. No chips. And by the way, they're building all of these EVs. Where is the lithium? Where is the nickel? Where is the cobalt? So at some point, the consumer is capitulating and saying, okay, I gotta buy the dip here because this is the best alternative available right now. If you need a car, you gotta buy it. Used car, yes, the prices are through the roof, unbelievable, but you gotta dip. And there are no new cars being built right now. So the consumer who actually needs a car right now will buy the dip, and the prices of used cars will be pushed higher again. So this piece of data from Jim Bianco and Car Gurus is an evidence that we're not seeing enough demand destruction in the economy. And you're not going to see enough demand destruction in the economy until the Fed raises interest rates aggressively. And by doing that, we see higher unemployment rate, lots of jobs being lost, a crash in the stock market, in the crypto market, in the bond market, in the housing market, and then we're going to have demand destruction, which could lead to a recession, and at that point, inflation would be poof, gone. But the road to get there will be extremely painful, no doubt about it. Now, I haven't forgotten about the rent thingy, which is keeping the CPI from moving higher. But let's go through the categories step by step. When we talk about energy, for example, you see that dotted line? That is all items, meaning the 8.5%, the CPI reading. Gasoline way exceeds the all items, the CPI reading of 8.5%. So is energy, so is natural gas, so is energy services and electricity. When we talk about goods, they're jerking off to used car prices dropping month over month. But look at this, all in all, used cars and trucks prices are way above the 8.5% mark. So is new vehicles, so is goods. But the good news is apparel. Inflation is below 8.5%, and so is medical care commodities. When we talk about services, airline fares way above 8.5%, car and truck rentals way above 8.5%. But here it is, rent of shelter and shelter inflation way below 8.5%. Again, you got to be a fool to believe any of that. This is garbage. When we talk about food, fats and oils way above 8.5%. Be careful here. If the prices of fat go higher, the pitchforks will come out right away. You think America will run fine without fat? Think again. Likewise, meats, poultry, fish, and eggs above 8.5%. Food at home, above 8.5%. Food in general is around 8.5%, but food away from home, meaning fast food, went below 8.5%. Thank God. We can eat fast food now. Let them eat fast food, which is, by the way, still expensive because the inflation in fast food is around 6 to 7% year over year. But here's the problem with rent. And Cassandra, Michael Burry, he tweeted all of this complicated data saying that the CPI is lying, they're not calculating housing inflation the right way, yada, yada, yada. And I say, you know what? You don't need all of these formulas and complicated stuff. Just keep it simple. When the CPI says inflation at 8.5%, just add 10%, which will give you 18.5%. This is the real inflation in the economy right now. And that is the minimum, by the way. When the CPI and the cooks say inflation for rents at 4.4%, who the are you kidding? Rent inflation in the United States at around 17%. In Seattle, for example, it's already 19% year over year. And look at this. You might want to pause here and look at all of this data because I tried to fit it in one slide, but here it is. And try to spot which city has an inflation rate of 4.4%, by the way, or even below 10%. New York City, 26%. San Francisco, 11%. Boston, 32%. San Jose, 13%. Miami, 34%. LA, 15%. Scottsdale, 28%. But here we have Long Beach, 9%. Denver, 21%. Orlando, 25%. Chicago, 10%. Tampa, 28%. So where is the 4.4% inflation in rents again? Branson, Missouri has 4.4% inflation. What about all of these cities? Where do you think Americans live? And even the government newspaper, the Washington Post, this is the CIA approved kind of data, even they say that rents are up more than 30% in some cities, forcing millions to find another place to live. Even CNN. So all of you who say, bro, you're a conspiracy theory, yada, yada. I'm getting my information from a Washington Post and CNN, you moron. And CNN says rent jumped 17% year over year. So where is the 4.4% again? Can you imagine what the CPI reading would be if rent inflation was actually 17% and it was calculated that way in the CPI's formula? The CPI's reading that we got today would have been at least 30%. So I'm being generous, by the way, when I say it's 18.5%. In all likelihood, it's way more than that. And here it is. They say that the CPI inflation at 8.5%. Let me fix this one for you. Here it is. Yep, a lot better. And what is the next step, by the way, after we got this hot inflation reading? We can get a clue from the Bank of Canada, for example. Yesterday in the program, we talked about Canadian inflation, and it's absolutely stunning. We're talking about over 60% of the Canadian public cutting down on grocery spending. They're having to choose what to buy. Unbelievable. And now the Canadian Central Bank says they're going to hike interest rates by 50 basis points in the next meeting. So if the Canadian Bank is going to do that, the Federal Reserve should do the same. At a minimum, 50 basis points in the May meeting. And even after that, they will still be way behind the curve because all in all, the Fed's fund rate will be at around 50 to 75 basis points. Inflation at 8.5%. Remember, to tackle inflation, the Volcker rule, you got to increase interest rates above the CPI reading. Assume it is 8.5%, which is a joke, by the way. The Fed is nowhere near tackling inflation. Let's say that the reality of inflation is around 18.5%, and it gets scarier when you start thinking that way. The Fed is not even close to tackling this inflation problem. So when you say that inflation is peaking, you better pull your head out of your ass, because today alone, look at the futures. Today alone, crude oil prices, the WTI, closed the day with gains of over 7%. Brent closed the day with gains of over 6.5%. Gasoline closing the day with gains of over 5.5%. Heating oil closing the day with almost 7% gains. And the same goes, look at lean hogs, 3% today. Wheat, almost 2%. Now, you really think that inflation is peaking? Well, you got another thing coming to you. And folks, we're going to move on here and keep this video short and sweet. And the reason is I was busy all day. I have work obligations. For all of you new subscribers, by the way, thank you so much for viewing, subscribing, liking, and being engaged in the comments. I love all of you, but I do this part-time. So today was not a good day, but yet I'm producing a video anyways. I'll make it up for you tomorrow by producing a longer video. But for now, we'll keep the remaining portion of this program limited to the charts, and we start with the chart of the SPY, the S&P 500 30 minutes chart. And here's the problem, folks. Right off the gate, we got a gap higher, and the chart was above 443 right away. Now, this was a trap from the get-go, and the reason is, if the chart really wanted to climb above 443, it could have done that tomorrow. Now, you could say, oh, but the chart perhaps was waiting for the CPI, yada, yada, yada. I say bullshit, because the chart had enough time to climb above 443. And it did not do so, meaning the chart needs to go down and retag another support, and if it finds support at that level, meaning the chart goes down and asks, any buyers, any buyers, any buyers? Is 438 better? If the buyers show up at 438, then we have a bottom and the chart moves higher. If not, the chart goes down to the next support, 434. It asks, any buyers, any buyers? 434. If there are buyers, then that would be the bottom and the chart moves higher from that point on. It was clear from yesterday's session that 443 was not that level. Did the CPI really change anything at all and made it more attractive as an entry price? Of course not. So today was a trap, and the chart lost 443 for a second day. Not a good sign. And it also lost 438 as support and barely closed at that level. The chart is getting oversold, technically speaking, when we look at the RSI, for example. But a reminder, this is a 30 minutes chart. What does that mean? It means there is a possibility of a rebound from 438, specifically if it comes hand in hand with lower volume till the end of the week, which will be, by the way, a shortened trading week because we don't have Friday. Good Friday, the stock market is closed. But that is the wishful thinking of the bulls right now. A lot of things have to happen before we get a rebound. Otherwise, if 438 is not a solid support, and it appears that it's not, by the way, we could go down to 434 and then check if we have support from that point on. It all depends whether the buyers are going to show up or not. For now, they're kind of traumatized. Put yourself in their shoes. Just a couple of weeks ago, they were talking about all-time highs once again. And I made a video and I said that the dip buyers are in for a surprise. Look at the comments in that particular video. The bulls were talking about all-time highs. You crazy, bro. What are you talking about? And now you know. So for now, they get a sour taste in their mouth. Something else has to happen before the buyers come back and buy the dip. And here's the daily chart for the continuous contract for the SPY, the S&P 500. The volume is moving higher, not lower, even though we are, technically speaking, in a shortened trading week. If the volume recedes in the next 2 days, we could see a rebound from 4,384.5, which is a critical support line. The bulls have to fight to keep that support line at least all the way till the end of the week. Folks, we got 2 days left, Wednesday and Thursday. Can you muster the strength to keep 4,384.5? I'm talking to the bulls, of course. Otherwise, if the buyers are not going to show up, then the bears are going to have a field day, and they're going to crash this chart all the way down to 4,232. But even if that happens, the bulls still have some hope left of the reverse head and shoulder pattern. But for now, the momentum indicators are a negative divergence. And the critical point for this week, the closing on Thursday, is, will the bulls be able to close the chart above 4,384.5, or will they lose that support by the end of the week? If they keep that support, then earnings could excite some buying. And we could see the chart recovering 4,472, for example. But if the bulls lose 4,384.5, that could be a big problem because it will excite more negativity and more bearish sentiment ahead of earnings. And here is the cash index, the SPX, the daily chart, and we're looking at the 200 days moving average in white, not even close. The chart didn't even attempt to retag the 200 days moving average. Not a good look for the bulls. On top of that, we have clear, strong negative divergences on both the RSI and the MACD indicator. The bullish theory is now limited to a retracement to close some gaps above, and the bulls would say every gap above was closed. That is true in the long run, but in the short run, you could see a lot of pain before that happened. And for now, the bears are in charge. So long as the chart is trading below 200 days moving average, the bears are in the driver's seat. What about the Qs? 30 minutes chart for the NASDAQ. This is a similar story, by the way. A gap higher, and it appeared, at least in the morning, that the bulls cheated their way and they reclaimed 343 as support. But you're not going to fool me that easily. If this was solid support, why didn't the chart climb that number by the end of the day yesterday? This is for a reason. The chart is saying 343 not a solid support. So we have to look below for support, and the next number I have is 334. Now, can the chart move higher and reattempt to climb 343 before going down to 334? Possible, specifically in a low volume week. If that happens, we got 2 days left, but it's not going to be a solid rebound, by the way. Why? Because reclimbing 343 based on low volume is a weak reason for reclaiming 343 as support, just like the gap that we got in the morning today. It is not sustainable. If you want to buy the dip in the Qs, you're hoping that the chart would go down. Better yet, in a gap down, a panic gap down to, let's say, 334, for example. And if that happens and the chart becomes oversold, then it becomes obvious. You buy the dip for a rebound rally, and it is smooth sailing from that point on until we get a reversal. I was hoping for that to happen today. It did not. The morons gapped the charts higher in the morning, and they ate a nice pie by the end of the day. And here is the daily chart for the continuous contract for the NASDAQ. Unlike the SPY, the NASDAQ bulls lost 14,000 as support, which kind of kills the reverse head and shoulder hopes. But the week is still young. We got 2 days before the closing. Can the bulls close above 14,000? Because if they can't, it's going to be a major problem. The next stop will be 13,599. And if we get there, the psychology says nobody wants to buy until we get a lower low. And that's going to be a major problem for the NASDAQ. So the bulls got to keep 14,000 as support. If you've been short since I told you to short, which by the way was pretty much the top in this rebound rally, this bear market rally that we got in the last few weeks, you're now up big. So what do you do with your puts right now? You're sitting in gains. There is no harm in taking at least, let's say, 50% of the table and then let half of the position ride. But if the bulls manage to rebound from 14,000 and close the week above 14,000, it is a clear signal for the bears to at least book profits from the put trade. It doesn't mean the market will recover entirely, but it means that the market is anticipating earnings. The bulls made money, the bears made money, the pigs got slaughtered. Now let's take a pause at 14,000, for example, and let's wait for earnings before we make the next move. All of this depends on the weekly closing. Is it going to be above or below? And here is a 30 minutes chart for the IWM, the Russell 2000 small caps. Believe it or not, this is a lot better than the SPY and the Qs. Why? Yes, we had a gap higher, but at the end of the day, the IWM kept the important support at 196.5. So if the bulls are betting on a rebound, this is the chart that could lead the rebound, the IWM. And the reason is it kept the support of 196.5. We talked yesterday about the knocking down over and over and over again on 196.5 as support. Is it to recheck for support or is it to break through the support? Here's the problem for the bulls. If it was theory number one, the chart is retagging the support of 196.5 to move higher, well, it did today in the gap in the morning. So why couldn't it move higher? Why did it go down to recheck 196.5 for support once again? This is not a good sign. It means that the chart is not confident for now to move above 196.5. And perhaps theory number two is in play here. You'll know when you know. You'll know if we have a rebound again from 196.5 and the chart closes the day above that number. But for today's activities, it did not give us a real answer. It only gave us mixed messages. On one hand, it closed above the line and it got a little rebound by the end of the day, and it managed to outperform the SPY and the Qs. On the other hand, the bearish hand, it failed to rally. It went down back to the same support line it has been rechecking over and over and over again for a few days now. Why? Is it because the chart wants to break through 196.5? This is something you want to think about. The Dixie, no stop in sight here. Every time you call the death of the Dixie, moves higher. We're now looking at 103 for resistance. If this rally continues, it's obviously strong. The RSI is reversing the negative divergence along with the MACD indicator, and this is bad news for the gold bugs because the gold bugs been waiting and waiting and waiting for this massive rally to come, and it's not coming yet because the dollar keeps going higher and higher and higher. But the resiliency, and we've been talking about this by the way, for weeks now, the resiliency of the chart of gold is telling that the moment the dollar tops, along with the 10-year yield, we will see gold exploding higher again. So I continue to be bullish on gold. What about oil? This is a 4 hours chart for the Brent. Look at this rebound and the recapturing of 100 as support. For all of the peak inflation talk, this is a big pie in the face from the chart of Brent, saying not so fast, folks. All of you have been saying peak inflation, not so fast. And the chart knocked at 105.84. It did not make it, but perhaps it ran out of time. Who's to say that the chart is not going to make it above 105.84? If that happens and it closes the day above that number, it would be a buy signal all the way to 118. And here's the daily chart for the 10-year yield. Perhaps the most important chart of the day. We have what it appears to be a reversal signal for now, but it has yet to be confirmed, by the way. We've been fooled once, we've been fooled twice, we've been fooled the third time in this rally of the 10-year yield. So we're not going to assume that this is the top for now, even though the technicals are overextended. We've seen that movie before. Give me the confirmation. And the confirmation would be losing at least one support line, let's say 2.54 in this case, and then we'll take it from there. And here's the TLT, a weekly chart, a bloodbath, a flush down. The moment the chart lost 128, you knew it's going to be ugly. Is the 10-year yield topping, and that means the TLT bottoming? We have to wait for evidence. We have to wait for the confirmation. And for now, we have yet to get a confirmation on the 10-year yield. If anything, it's going to continue to move higher because the Bank of Canada now says 50 basis points. It would be absolutely weird and controversial if the Federal Reserve goes with 25 basis points in the next meeting. Therefore, I continue to say 50 basis points is now in the bag pretty much. What about the VIX? This is a 4 hours chart. It is having a hard time breaking above 24.29. It is a stiff resistance after all, but the momentum indicators are firming. They're moving higher, indicating that we don't have a reversal signal for the VIX yet. That could happen tomorrow, could happen next week, but for now the assumption is VIX goes higher, SPY goes down until and unless we have a reversal. Either way, in either chart. And here's the VXN, the VIX for the NASDAQ. It is consolidating for now, building that energy to do what? To move higher. How do we know that, by the way? The momentum indicators, the RSI, the MACD are telling us the chart is in positive momentum and it has yet to peak. We don't have any reversal signal yet. So the assumption for now is Qs should go down, VXN should move higher. What about Apple? What's going on here? Apple reattempted to recapture the upper line of the channel as support once again, and it could not make it. So if you're looking for evidence of the weakness of the NASDAQ, here it is. Apple could not make it above the important support line, which remains as resistance for now. Furthermore, the momentum indicators remain in negative divergences, and the volume is moving higher on down days. The NASDAQ is not going to make it higher without Apple participating. Here's another important component of the NASDAQ, Tesla. This is an hourly chart, by the way. Tesla made it higher above 995, but just like we talked with the chart of the Qs, if 995 was strong support and an easy support to climb above, that should have happened yesterday, but the chart could not make it above 995 and it closed at the lows of the day. So when we have a gap higher in the morning and the chart trades above 995, are we a bunch of fools to fall for that? Of course not. And it did not take so long for the chart to lose 995 and close again at the lows of the day. Now, could Tesla make it above 995? Yes, but under one condition. In the next 2 days, if we have lower volume, no resistance, then the bulls could move it higher easily. No doubt about it. Some buying of call options would do the job, but the problem becomes what is the sustainability of the move higher? If it happens under low volume, if it happens because there was no resistance, everybody was out. A similar story with tulips, BTC, Bitcoin. We have a mini rebound for now. Are we going to fall for this one? Not really. You got to show me the money and recapture 42,000 as support, and then we'll talk. For now, the assumption is the chart will go down to 35,750. But what if we have no resistance, we have lower volume in the next couple of days, or we see a rebound and the chart indeed reclimbs 42,000 as support? We're still not going to buy it until and unless we see the sustainability of the rebound. That's not going to happen until next week when the volume comes back. And of course, all of this talk, by the way, is under the assumption that we're going to have lower volume in the next couple of days. It's not in the bag because we have earnings from important banks, and that could spike the volume higher, not lower. And lastly, what about AMC? We're now waiting and waiting and waiting for a rebound, at least to retest 21 as resistance once again. I'm waiting for it. It's going to be a good trade. Buying calls, let's say the 20 calls, and you get a rebound all the way to 18, maybe 19. These calls will appreciate in value immediately, but it's too risky right now. We're seeing somewhat of a saucer bottoming in the RSI and the MACD indicator, indicating that the negative momentum is bottoming and the chart is ready for positive momentum. But there is one condition has to be met, and this condition is the participation of buyers. Where are the buyers? How come we're not seeing call options being bought on AMC? How come we're not seeing the apes buying shares of AMC? Well, they might start to do that if they realize that we're going to have a lower volume for the rest of the week. We could see a rebound higher. I will be watching this chart in the morning. And if I see signs of bottoming and rebounding, I will be buying calls for a rebound rally. And with that, folks, we're going to move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Producer Price Index final demand, and on the earnings calendar, we have JP Morgan Chase, an important indicator for banks, and then we have Delta Airlines, an important indicator for the airlines and transportation industry. And lastly, we have an important indicator in BlackRock for the entirety of the market, but perhaps what's going on with the bags we're about to see from the Russian operations. 3 important earnings, 3 earnings that could move the market higher or down again. So buckle up your seatbelts, but this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.